The spirit of innovation is deeply ingrained in America, and Google is helping Americans innovate in ways both big and small. The Department of Defense is working with Google to help secure America's digital defense systems, from establishing cloud-based zero-trust solutions to deploying the latest AI technology. This is a new era of American innovation. Find out more at g.co/American innovation.
Reality radio for a really great future. We're talking real money.
Hi, everybody. Welcome to the show. I'm Don McDonald. This is a place where we can spend a little time trying to make a topic that can drive you a little bit crazy, or lately a lot crazy, more understandable, more approachable, a lot simpler to deal with, because money's so important. You need to earn it. We hope you save it. We are all pretty good at spending it. Investing it gets a little dicey at times because we've got so much bad information out there. So let us help you make money more understandable, and then maybe help you make more money. 855-935-TALK is our telephone number here. That's 855-935-8255. I'm Don McDonald, along with Tom Cock, who's having some technical difficulties in the new studio right now with his tie line dialing in machine. So I'm here for you. Now, one of the things we've been discussing a lot is the stock market, because over our lifetimes, baby boomers, the stock market has become an increasingly important part of our future life. Prior to the 1960s, really, 70s primarily, stocks were an area that very few people dealt with. They rarely invested in stocks. Today, a lot of people invest in stocks. And the problem is, when things happen like they have happened recently, there are a lot of people who aren't really comfortable. They don't understand the stock market. They say, what should I do? What should I do? And, we know most of the experts are going to say, don't sell. But are there times when you should sell?
Yeah, there are, because sometimes, and by the way, just to correct a little bit of your history there, in the 1920s, of course, millions of people were investing in stocks. They were borrowing money to do it, but there were a lot of individual investors that got burned in the crash of 29. Yeah, so sometimes there are actually times, but not for the reason you might think. Not because the market went down or the market's unsettled or we don't know what's ahead. The reason you might not want to be so equity heavy is, well, you need cash to pay the bills in retirement. Now, there are people I run into that make no allowance for any of this. They simply have a portfolio, and then when they need something, they sell stocks or bonds. Likely, when you're in retirement, you should have 6 months to a year of cash set aside, Don, and people have a tendency to forget that. Number two, this came up recently with a discussion where someone thought they'd built the right portfolio, but they had never rebalanced it. And they started with a 50-50 portfolio or 60-40, and now it was 70% in stock. So sometimes you got to rebalance that, and you may end up with cash as a result of that. If you're in retirement, then again, you're going to create that cash. And then finally, this is the part that we have spent a lot of time on, and that is around risk capacity. Let's talk a little bit about what risk capacity really is. That's an important concept that most people do not understand.
Yeah, risk capacity, I call it risk profile. I think that's a much better term, because it takes in your tolerance for risk, which is how strong your gut is. Where's the number where it really starts churning and you're starting to panic and you really get worried? That's your risk tolerance. To determine your risk capacity or your risk profile, you also have to add in something that not a lot of people think about. It's all about, well, let's win the game, make as much money as we possibly can. No. Make as much money as you possibly need. Why should you take more risk to make more money if you don't need that more money. You are not going to leave this life as the richest person on the planet unless your name is Musk or maybe Bezos or possibly Zuckerberg, but more than likely it's not you. So you need to combine your risk tolerance with your risk need. Don't take more risk than you need to take. Then you can create a portfolio that is even more comfortable than you might have right now, and so you sell a little bit to get to that. 855-935-TALK is our phone number. Give us a call.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
You know, I hate to correct you, Tom, but in 1929, only about 6 million people invested in stocks, which was about 5% of the population. By 2024, it was 61% of the population, or like over 200 million people. So it was smaller back in 1929, even as a percentage. 855-935-TALK is our phone number, 855-935-8255. Let's head down to Georgia. Paul, welcome to the program.
How are you guys doing today?
Pretty good, sir. Thanks for the call. What's up with you?
My wife and I just finished last night watching the Tune Out the Noise movie.
Oh, the Dimensional Funds video on YouTube. Yeah.
And I just want to thank you all for that recommendation. It was one of those things I wished when I was in college 30 years ago I had seen that, or something, not that, but, a similar type of.
That was something that shared that perspective on how investing really does work. Yeah.
Because I had, multiple relatives. I think I had an uncle that I highly respected, that he picked stocks, and he and his neighbor traded Barron's and the Journal back and forth in the afternoons. And he thought, well, he's a smart man. He's picking stocks, he did pretty well. But of course, I don't know about his losers. But anyway, but that movie was just really great, and it's kind of timely to me, because right now, when all this stuff is going on with the tariffs, I'm literally tuning out the noise. I just don't care,
That's exactly what the point is. And by the way, that's exactly what the point is of our show. I've said over and over again for the many, many years Tom and I have been doing this, that really if people listened to us and actually paid attention, there would be no need for us to do this, because we would all just naturally tune out the noise. But thank goodness people are emotional, so we have a job. But you're right. And this movie, we did an interview. If you're a podcast listener, go back and listen to just a couple weeks ago with the chairman of the board and the CEO of Dimensional Funds. They made this documentary. Errol Morris did. I'm sorry?
I heard that. That's where I got it from, listening to y'all talk about it. Yes, sir.
Yeah, and what in it, what they do is they discuss the creation of dimensional funds, which we've talked about many times, which we believe their approach is great because it's based on academic research, not hunches and seat of your pants investing.
That's cool. Well, can I get to the crux of the reason for calling y'all today?
Absolutely. Yes, sir.
Please.
Well, of course, a laundry question for Tom.
Oh, a laundry question,
it's a
Tom.
nice day today.
Oh, yes. Always go with the spin cycle. That'd be my suggestion.
Well, it's a nice day in South Georgia, and we've got a back patio with kind of a little shelter, and I decided to hang up some pants and just let them air dry. Do you ever do any air drying out there in Washington? Do y'all ever hang out those dryers?
Wait a minute. They call it in Washington. They call it air wetting. They call it air wetting. It's like you put your clothes out and they come in wetter than you put them on the line.
Yeah, those 3 days this summer, sure, we'll be happy to do so, but otherwise, no, not going to happen.
Well, it makes them it makes them smell so good. I don't really care about the energy savings on it. I just when they hang out and dry like that for a little while and the wind's blowing, it just makes them smell so good. And so
I remember that from my days as a child when we didn't have a dryer, but now that I have a dryer, as a matter of fact, where I live, clotheslines are illegal. Can't have a clothesline. So
because
I'm glad you're able to do it.
The way they look?
Yeah, because of the way they look. What?
Down where you are, Don, it's probably so humid down there, they just stay wet.
Oh, they would. Yeah, they would. But where Tom lives, it just rains all the time.
The sun was out for about 3 minutes and then started raining again. Yeah, so no.
Well, we appreciate the laundry question.
If y'all have any more book recommendations or movie recommendations, please throw them out to us.
We will. Just keep listening. We'll keep doing it.
You
Thanks so
mentioned
much.
baseball earlier, Don. If you're a baseball fan, I'm reading a great brand new biography of Earl Weaver.
He didn't ask about baseball.
No, you mentioned baseball.
I don't care. Yeah, but I'm not going to read a baseball book.
Oh, it's a great book. Earl Weaver, great manager.
I saw that in the journal, that book that I recommended.
Yep. I love it. It's a heck of a story about baseball. And
Earl Weaver and Billy Martin going back and forth fighting. Remember that?
That's right. It's well documented in the book, so you got to love it. So,
ladies and gentlemen, welcome to Sports and Laundry Talk.
I'll take a look at the Earl
Speaking
Weaver
of bad-smelling pants,
Yeah. Talking real money, sports, and laundry every day on the podcast. Thanks for the call, sir. We appreciate it. 855-935-TALK is our phone number, 855-935-8255. But check out Tune Out the Noise. It's on YouTube. And I believe
over 5 million views already.
Yeah, last I looked, it was like 4 or some odd million, but so it's over 5 million. Yeah, over 5 million views. You can go watch it for free on YouTube, and it really is a terrific movie. It's worth it. It is. If you want to know why we believe what we believe, this really is the origin story for the investment style that we believe makes the most sense. And once you watch it, you'll go, oh, I get it, because they explain it so well, and it's just 90 minutes. You can pull off a 90 minutes.
Is that all it is? It was just 90 minutes?
It's an hour and 28 minutes.
Yeah. Yeah, it's well done. I mean, it's Errol Morris, first of all. So
he's a good documentarian.
Well done. It's a good piece. Yeah, he is. So, yeah, I'd highly recommend it. Or you just want to see David Booth's art collection. There's that availability
basically,
as well, so.
Yeah, the whole movie is the imagery is a lot of his outdoor art collection. Which, when you have a really, really great idea and you turn it into a really, really great business, leads to really, really great sums of money, which allows you to buy really expensive art and put it in your yard and give money to the University of Chicago and University
I was going to say a really, really good business school that has his name attached to it now, too. Pretty good school.
Yeah, you ever heard of the Booth School of Business? That's the same guy, David Booth from Dimensional
David
Funds.
Booth, yeah, right. Yeah.
So it's really a terrific story, and it explains a lot about why we don't want you doing so many things that CNBC and Fox Business and the Wall Street Journal and Barron's and Market Watch and all
Edward
of these
Jones
and Ed Jones and all the brokerage firms, the things that they espouse, which is trying to be in the right place at the right time, which is trying to predict a totally unpredictable future, which is trying to figure out how to be in the right place at the right time and then out of the wrong place at the right time. And if you do that, you're just going to make yourself crazy, and it turns out you're probably going to make yourself poorer too.
Everything we know says that, and the people that use science to invest say that. The academics who study that say that. So, yeah, it's a great film and just beautifully done. So take advantage of that.
Yeah, and make sure you give us a call. Every Saturday we're here, 855-935-TALK. That is 855-935-8255, and just about anything that has something to do with money is a potential topic. You just need to bring it up, and we'll bring it right back after a really quick break. Don't go away.
Tom and Don are talking real money.
You're the owner of a small business, which means you're also the tech guy and HR and personal assistant and head honcho and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit Verizon.com/smallbusiness to book your appointment. Verizon Business.
For your real life and real future, Tom and Don are talking real money.
Saturdays, no matter when you listen, a lot of you listen to the podcast, and you can send us questions at talkingrealmoney.com for that, but you can call us every single Saturday. Either both of us most of the time, or every once in a while, like next Saturday, one of us, me, at 855-935-TALK, 855-935-8255. Call right now. We've got lines open and lots of time. Let's go to Washington. Tom, you're on. Welcome to the show.
Yes. I watch stuff on Facebook, and every once in a while I will see ads that say, you are losing money by converting to a Roth the wrong way. And they want me to subscribe to whatever it is to see if, I don't know. I have no idea. I've never clicked on those. But I said, is there a wrong way to convert? You know, I just do like $25K a year. Do you understand the question?
I'm trying to figure out. I've never seen the ad.
I've never seen the ad either, because there really is only one way to convert. Move money from your IRA to your Roth IRA and pay the tax on that. So I'm trying to figure out what they mean. My guess is they're telling you to invest in something else that is going to make you more money than you would have had you been invested a certain way. That's a guess, but can you tell us about who is the sponsor of that?
Yeah, because I'm trying to look it up and I'm not finding it.
Well, I've always just kind of ignored it, but they're saying that that I have, unless you have a plan, if you get their information, their book or whatever it is, you can get a plan that will tell you, you know, this year you need to maybe do 50,000, and next year.
Oh, so it's okay. So basically, what they're probably selling is a financial plan of some sort, or a tax planning service where you can look at what your tax liability will be. They're selling something, but I don't know what it. The only mistake you could make would be kicking yourself into too high a bracket when you're making the conversion, and really
there's
making
there's one other.
Paying taxes out of the Roth itself.
That's right. You don't want to pay the tax out of the IRA that you're moving over to the Roth. That would be another mistake, yes.
They could be talking about the pro rata rule for a back door, maybe?
Yeah, maybe. But that's not a conversion per se. I'd be interested to know, because I do think, to your question, Tom, this is one of those things that everybody thinks is a no-brainer. I'm just going to go ahead and do it. I run into people that do that while they're working. And I say, well, you have until, in this case, they had until age 75 and they were in their mid-50s. I said, you have 20 years to do any conversions, and you're making $200,000 a year. Why would you want to pay in a higher bracket? Wait till your lower bracket. It feels like a great idea, but it should be vetted carefully. So if they're telling you to do that, then I like it. If they're telling you, buy our book,
buy an indexed annuity instead of converting.
Yeah, that might be too.
Yeah, actually, I think you guys are right in that. You know, my accountant every year tells me how much I should do, and I bet it's so that I keep within whatever tax bracket.
Yep, probably all it would be.
Yeah.
I can't think of anything else.
That makes sense.
I can't think of another thing.
We don't spend enough time on Facebook.
I don't
to do it.
I literally stopped. I went cold turkey.
I never was
Facebook.
on it, so
you never were on it. I was on it for a while.
No,
I was mainly on it for my community conversations, but I'm off of it. I'm Facebook free, and I feel so much better for it.
But downstairs in your house makes up for the upstairs.
Yeah. Yeah. Well,
thanks for the information.
Thank you for the call.
Thank you, Tom. Appreciate it.
Keeping
Great
your
call.
information on Facebook. Yep. Bye.
All right. Thank you. Take care. I think we're on Facebook.
I think we are. I think the
I just don't
company
think
is, et cetera,
I
so.
stopped updating it eons ago.
Yeah.
Let's see. Let's see if I can.
As
find
social
it.
media as I get is LinkedIn, which ain't that social media-ish.
It's never been that good for us. Social media.
No, everybody thinks it's a no-brainer. You're going to get everybody's going to get all these clients and that stuff. They haven't found it that way. So,
Talking Real Money.
we have our own Facebook.
thing. We did post. I forgot. Debbie did post to the. No, she didn't. She didn't post to the Talking Real Money. She just mentioned Talking Real Money, so it came up.
Thank you.
The last time we posted to Talking Real Money was February 2023. That was for retirement.
2+ years, yeah.
2+ years. 855-935-TALK is our number.
Tom and Don are talking real money.
At Capella University, you can learn at your own pace with our FlexPath learning format. Take 1 or 2 courses at a time and complete as many as you can in a 12-week billing session. With FlexPath, you can even finish the bachelor's degree you started in 22 months for $20,000. A different future is closer than you think with Capella University. Learn more at capella.edu. Fastest 25% of students. Cost varies by pace, transfer credits, and other factors. Fees apply.
Reality radio for a really great future. We're talking real money.
Our phone number, once again, is 855-935-TALK. That's 855-935-8255. Give us a call. Let's go to Seattle. And Roger, welcome to the program.
Thank you. I've got a question about Roth IRA conversions.
Okay.
My big picture question is I'm coming up on the age where I'll have to start doing RMDs for my 401k, and I'm wondering if I can still get away with eventually or two-step wise converting that money, moving that money to my Roth IRA. I realize to do that I have to route it through my regular IRA first. So is there a restriction on routing RMDs to my regular IRA, or do I have to take it out and put it in a conventional account? And then once it's in my regular IRA, is there an age limit at which point I'm no longer eligible to do Roth IRA conversions?
There's a lot there. So, okay,
Yeah,
so first of all,
I'm confused. I'm trying to...
just to be
you
clarify
can't
a couple
convert
of
an
things.
RMD...
No, that is clear. Required minimum distribution is going to be
have to be taken out and taxes are paid. Yeah.
Yep, no question.
Okay, but
then this aspect. Go ahead.
Do I have to move the RMD funds directly to a regular account or receive a check, or can I route that through my regular IRA, provided I immediately then?
I'm not sure what I. That's the part I don't understand. You mean?
No, he thinks he can move it.
You can't
from
take it. You
his
can't take
401k.
the 401k RMD and move it into an IRA. No.
Nope.
Even though I then immediately pull it out of the regular IRA so that I can convert it to a Roth IRA, I can't do that.
Nope.
Is that what you're saying?
Nope. The RMD is a conversion to a non-protected account of those dollars, and then
be careful
taxed
saying
on
conversion there, because that makes
not
it confusing.
conversion. I mean RMD,
Yeah.
the distribution. I meant the word distribution.
Yeah.
Senior moment.
Distribution. You're taking the distribution. You could put that into a brokerage account. You can put it into a bank account, but you cannot move it into an individual retirement account. No. Now, as to your other question about moving the money, taking money from your 401k plan and doing a Roth conversion, it's my understanding you could take it from the 401k, move it right to the Roth, because they're going to send you the 1099 for that distribution anyway. But then you just immediately move the money into your Roth, right? The conversion. That's fine.
Yeah, it wouldn't have to make the intermediate step.
No.
Okay,
but you pay
my
taxes.
understanding was that I understand that. I just don't want to keep paying taxes on it for the rest of my life. I'm leaving it tax-free for my beneficiaries.
No, you're going to have to pay taxes on it for the rest of your life. It cannot be re-protected from taxes.
If I so I can't. What Tom just said, I can't go directly from my 401k to the Roth IRA and have that count as my.
No, you can
and pay taxes.
Not as you're just. You're getting confusing here. The required minimum distribution has to be made no matter what. That's a separate issue, no way around it. What you're talking about is doing a Roth conversion in addition to that. That's fine, but there's no intermediate move. You can take the money right out of the 401k and move that into your Roth IRA.
And pay taxes on it when you take it out of the 401k.
That's fine. But I thought I had to have it. I could only convert funds from a regular IRA and not funds directly from a 401k. That's what I've always been told. So who's telling me that is wrong?
I don't know. We're going to look it up because I've never heard that before. It's an awkward way to do it. I agree, but I don't know. And Don's typing that in on the interweb right now because I'm not sure.
Yeah, you're able to. The law allows it. Yes, you can transfer a 401k to a Roth IRA if your plan allow. Well, wait, are you participating in the plan still? Or it's an old plan?
I did some independent consulting years ago, and as part of that, I set up an independently.
So this is no longer being funded. Yeah, okay. Because the only caveat on this is if you're still working and they don't allow in-service withdrawals. But this is an old 401k. So according to what I'm reading, and I don't swear by anything, but according to what I believe, you can convert your Roth or your 401k, regular 401k, to a Roth IRA without the intermediate step of moving it into an IRA. Even if you did have to move it into an IRA, though, it should be a no cost, no hassle step. I mean, you could, let's say the 401k is with some other company with Empower. You can move it over to Schwab and say, Schwab, I want it in the IRA. Now move it to the Roth IRA. Then you pay taxes, and it sits in the Roth, and nobody pays taxes after that. But if the trick is to try to find
terms were.
I'm sorry?
What was your search terms for looking that up?
Hold on. Be right back.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
All right, I did a whole lot of research during the break. I went to Fidelity, I went to Vanguard, and I went to Schwab and searched all of their sites, and every one of them says you can convert a traditional 401k into a Roth IRA. So it appears directly from those horses' mouths that direct conversion is possible. You don't need to have an intermediate stopping point along the way. But it is so important because we hear this a lot, and we have to dig beneath the surface to find out what the intent is. If you are trying to avoid taxes, it just doesn't work, okay? Just period. It doesn't work. You can't get out of paying taxes on these retirement accounts that were tax deferred. If you want to move them into something that grows tax-free like a Roth IRA, there is going to be taxes. There are going to be taxes. And if you want to, you cannot convert your RMDs into anything that's tax advantaged except for like tax-free municipal bonds or an annuity or something.
It's very confusing. Yeah. So you got to do the RMDs. There's no way around it. No, there is one way. The RMD you could do is a QCD. How about that?
Wait, no, we're not getting into qualified charitables now, because that means you have to give it to somebody else.
I know.
You don't get to keep the money. It's gone.
No, you do not. You do not.
855-935-TALK is our phone number. Give us a call. We also take your questions at talkingrealmoney.com. You can go to the contact form and you can type them in, and they go to Tom, or you can speak them in and they become part of the Friday podcast. But Tom he needs more typed questions. His gigantic 30-foot pile is now down to mere inches. Okay,
it was
centimeters.
Cold this morning. I had to make a fire, so I had to,
that's what happened to them.
Yeah, it was like in the 30s. Thomas from Spanaway writes,
Thomas?
Just Thomas. You've recommended several times a paid site for checking on Social Security projections, which I didn't know we had.
No, we don't. It's Lawrence Kotlikoff.
Okay. I didn't know you had to pay just to make a calculation there.
Yes, you do.
Because there's others where you can get it free. But he said take a look at the site and consider this book. Social Security Made Simple, Social Security Retirement Benefits and Related Planning Topics Explained in 100 Pages or Less, written by Mike Pepper. Now, I did go look at the website, which is opensocialsecurity.com, which has a calculator in it, and I looked at it, I scattered it out a little bit. I did like it. It's, as he said, it's relatively simple. Here's the thing about Social Security. It's not relatively simple. And everybody who does this, who wants to do it on their own, God bless you. We've been telling people you could manage your money, take care of all this on your own for many years. Around Social Security, I would at least get a professional to look at what I'm doing, because it's such a huge decision. And after 6 months, you can't fix it. It's done. It's over. It's set. So, yes, this is not a bad website, opensocialsecurity.com. And thank you, Thomas, for your suggestion. That said, I would still get a professional to look at my decision.
I can tell you, Maximize My Social Security, which is the website by Lawrence Kotlikoff, is far more robust than you can get on any of those other calculators.
Gold standard.
It's $49 a year. So what you do is you pay the $49, you do the information, and then you cancel. Remember to cancel. We always forget to cancel these things. Yeah. Well, no, what I do is I immediately cancel, because they let you do the rest of the year, because you got the year subscription. It just won't renew.
Oh, okay. Yeah, okay.
It just won't renew.
Yeah,
but that's a good resource. Do you have any more?
So huge. Yeah, I got tons more. Well, not tons more. I got more.
Let's do one more. Then if we want to, we can talk about that other thing. If we want.
I don't remember what the other the other thing.
Yeah, the guy with the merry men.
He robs
that
from
one. The rich, he gives to the poor.
We could just do that one instead if you want.
We can if you want. No, I
think we should. No.
Okay, let's do Robinhood.
You asked for a question. Okay, you want?
Okay, do a question. I don't.
This is very confusing. Very confusing. All right, question.
Yes.
John from Mobile, Alabama says, consistently you stress the need for a well-balanced portfolio. Recently, you pointed out how a well-balanced portfolio has fared better than one made up of only equities. However, it caused me to ask myself a question. If I'm investing for retirement that's 20 years away, why would I add bonds to smooth the volatility along the way? If a well-diversified portfolio of just equities has historically resulted in higher returns in the long run, say a 60-40 portfolio, why would my goal be to smooth the ride and most likely sacrifice total returns? Of course, many might sell during downturns, but that isn't a flaw in the investor, rather a flaw in the investing strategy. Love to hear your comments. We never said you make more money by being in a balanced stock-to-bond portfolio, because it doesn't make sense.
No. As a matter of fact, we've often said if you wanted to make the most money over the past 100 years, put all your money in small cap value stocks. You would have made so much more money, but there would have been times when you probably would have seen a 60, 70, 80% loss. And that's why we're not telling. This is a show made up of broad generalizations because our audience is tens of thousands of people. We have to generalize. Generally speaking, most people need some bonds in their portfolio to keep them from that thing that you said, which is selling when things are down. That has to be part of your strategy. That's not just a flaw. We have done, would you say, hundreds of live classes with people?
Oh,
probably.
Yeah, for sure.
Yeah.
Going back to the Merriman days, absolutely.
And tens of thousands of people. And in the old days, with every audience, we would say, how many of you are comfortable with you have $1 million portfolio? Imagine you have $1 million sitting in front of you, and I take $500,000 of that away. I take $500,000 away and tell you I'm pretty sure I'm going to be back with it, but I don't know for sure, and I don't know when. It could be soon. It could be a couple of years from now. I don't know if I even come back, but pretty sure I will. I've always come back in the past. So trust me. How many of you are comfortable with me taking $500,000 off your pile of $1 million?
And you know how many hands go up?
I think out of 10,000 people, probably 3.
Not very many hands go. I mean, you didn't even go down. We reduce it. We say, how about 30%? How about 25%? Very few people say, yeah, okay, I'm all right. They don't want to do it.
Human nature requires that we suggest you do that. Otherwise, the worst case we have seen to date is about a 50% loss in a year. And that was painful. I remember it. It was painful.
Yeah, and it wasn't that long ago. That was the fall of 2008 into early 2009. That's not that many years ago. We had a pretty sharp downturn in 2020, another pretty good downturn in 2022. Stocks on
another
average
downturn
this
in
year
2025.
Yeah, right. I mean, so these are things that you're right. Had you just put it all in small cap value for the last 100 years, I think your return would be somewhere between 12.5% and 13% a year, something like that. It's pretty dramatic.
Huge. It's been a wonderful number.
But you really had to swallow hard a few times, as you say, seeing your portfolio go down by that amount. Very few people can take that kind of beating.
If you have the time and you are capable of writing a note to yourself that says, no matter how bad the economic situation looks, I will not sell, period, exclamation point. And you post that on the wall right where you can see it every day. Unless you're confident that you're going to not do anything after doing that, you probably need some bonds. We'll be right back.
Tom and Don are talking real money.
This episode is brought to you by Amazon Business. How can you free up your team from time-consuming office tasks? Amazon Business empowers leaders to not only streamline purchasing, but better support their teams so they can focus on strategy and growth. Free up your teams and focus on your future. Learn more about the technology, insights, and support available at amazonbusiness.com.
For your real life and real future, Tom and Don are talking real money.
Now, when we suggest that you keep your money with one of the major firms out there, Charles Schwab, Vanguard, Fidelity maybe, because they're all pretty good custodians, there are some newcomers out there who would like you to custody your money with them, people like, well, Robinhood.
Yeah, they're coming up with a lot of deals lately.
They're giving you free money.
They're still doing that 3% deal, right?
Yeah, for a gold card member, 2% on an IRA, unlimited 2% on an IRA transfer or 401k transfer.
Then, did you know the average? I find this funny. The average age of the users at Robinhood has really gone up from 31 to 35. Okay, that made me kind of.
But here's the thing: why would I not do that? Why would I not take advantage of this free money deal?
You know, I don't know why. Actually, I mean, because a custodian, to me, is a custodian is a custodian. Now, you have said something in the past like, but if you're comfortable with Fidelity, you know how it works, you're on their website, blah, 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 then okay.
Yeah, but Robinhood's becoming more mainstream.
I hate Robinhood.
You hate them.
Well, I hate them. I do. I'll tell you why. Because they do things like allowing you to bet on college basketball tournaments.
What?
Yeah, I think that's just absolutely shocking. They also allow you to bet on interest rate moves. I mean, things that you just shouldn't get anywhere near. And so by encouraging those things, I don't want people to put their money there. I'm sorry, but I think that's really,
have a prediction.
That's just horrible. Yeah, right.
Yeah, see, they do, they gamify investing. They're turning it into a game, and it's not a game. So I guess that would be the one downside, is that you have to be able to resist their pitches to play with your money, and they make money when you play with your money. If you just park it there, they lose money.
Yeah, they do. But so that would be a reason I would not use them as custodian. But back to the other ones, Schwab, you mentioned Fidelity, Vanguard. Now, we use Schwab, but we work on the institutional side, and they have a program for us, and we got people we get to talk to, et cetera. It's a different relationship than if you're a retail customer. So that's why I like Schwab. But in today's world, you can buy almost any security anywhere for no commission, right? What am I missing?
Right.
You can have online access.
Unless you're with a major brokerage firm. The major brokers still charge commissions, but the formerly known as discounters.
Yeah, exactly. Thank you. Discounters. That's funny.
But, again, if you have the ability, the fortitude to avoid their game playing that they want you to do to get rich quick, Robinhood could be a very good place to custody your money, particularly if they're getting ready to do a 401k, a big 401k rollover.
And you get 2%? That huge match, right? That's a lot of money. Think of 100 or 500,000. That's quite a bit of dough.
We're talking serious money here. We're talking real money.
Wait, serious? That's
real money. Real money. We're talking real money.
Mm-hmm. Okay, that's good.
All right.
So, I wouldn't. We got to go. Reasons I wouldn't hire them for that reason. So, but for their,
we got to go. Next week, please join me for my solo performance, as I am a soloist here on Talking Real Money, because Tom's leaving me. And if you want to send in some questions, go to talkingrealmoney.com. Use the Contact Us button. If you want some help from one of our wonderful advisors, including Tom, all you need to do is go to talkingrealmoney.com and then look for that button that says Meet an Advisor. Set up an appointment, and it's free. There's no obligation, no high-pressure sales pitch.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.